This week has been an absolute snooze fest, but I don't expect it to last very long. The market seems to be preparing for a big move tomorrow with the PCE inflation numbers and the jobless claims acting as a catalyst coming out at 8:30 Eastern. If we can break from the balance range compression, we will be watching for range expansion. So, let's take a look through the data points and build a logical game plan for the rest of this week. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So let's kick things off with a closer look at the SPY daily time frame chart. The first question that we always ask here is what's going on with the trend? We've certainly got lows, and higher lows. Along the way, we had highs, equal highs, and we broke out to a higher high, new all-time high on the Friday session of last week. That's where we're pulling back from. So we know on the daily time frame, this pullback is searching for a higher low without really having the opportunity to jeopardize our daily uptrend. The key higher low zones are really as follows. We know that we want to see prior resistance now act as newfound support. So the picture perfect rainbows and butterflies higher low is staying over 503. Can we find buyers here? But even if we break down underneath that level, just remember that there's still technically the opportunity for a higher low over 497 on the gap fill reversal. Right now, there's not really a lot of wiggle room at the high of the Wednesday session of last week. Remember that this is the NVDA earnings gap up here. But if we can stay over 497 for a gap fill reversal, technically you have the opportunity for low, higher low, and a very nuanced higher low at that level. Of course, as we conceded in the Saturday update video, if there is some sort of rejection on the retest then at 503 from the downside, yeah, of course we would concede that now we're dealing with a head and shoulders, but one step at a time. The first part of this sequence would be looking for buyers to step up at the gap fill reversal, once again, 497. If there is a move in the upward direction, let's just say that PCE goes swimmingly tomorrow morning, there's a move higher. There's a couple of points that really capture my attention. First and foremost, Tuesday's high. It's basically a 2-day high, considering today was an inside bar, but breakouts over 507 continue the trend in the upward direction, or just breakouts through the previous all-time high here at 509 also continue the trend in the upward direction. So on the daily chart, there's really been no damage done to the overall trend. We know our key zones that we're paying attention to, 503 and the prompt gap fill reversal over 497. We could break the 2-day highs for a long here, or a long up and over the opening print of that Friday session, roughly 509, also gets trend continuation higher. If we think about the structural bars, really not much going on here. Monday, a little bit of a breakdown. Tuesday, we'll talk about the failure on the hourly chart in a moment here. And as we just described, today's Wednesday session was totally just an inside bar. So let's take a deeper dive on the hourly. So as we can see, the short-term trend is certainly down with consecutive lower highs as well as lows, lower lows, and lower lows in here. But if we're thinking about the opportunity for the buyers to really step up, is it not possible that this could actually start to act as a double bottom where you get lows, equal lows, a break of this neckline is the 2-day high break, and then we're back in the upward direction as described on the daily time frame chart. So that's one opportunity here with a break up and over 507 looking for longs. If we were to see a breakdown of the range, I think what you're looking for is just a bear flag, right? This is sort of your idea. There's your hockey stick, break lower high, and then it's a test of 503. So those are 2 possible situations to get out of this range, but I don't necessarily think those are useful because PCE, if it misses or beats expectations, as long as we're not at the expectation, I do imagine that the market could produce some sort of gap. Now, before we talk about the gap, let's just firstly understand who is strong and who is weak in this market. It continues to be the big $1 million question that we ask over and over again. So the Tuesday interaction really is a big deal. If you look at Tuesday, which is technically this price action right here, here's Monday's price action, right? Tuesday breaks for a new 2-day low into the mid-afternoon, and then end of day, we move back higher for a close in the midpoint of the Monday range, right? Here's Monday's range, right about in there. So if stronger sellers were entering this market, is it not unreasonable to ask of them for a closure underneath the previous day's low? I mean, you broke the low, fantastic. What business do we have up here producing an equal high back to some of our intraday rejections into the afternoon at 507 on Monday afternoon? It just doesn't make sense. If stronger sellers were truly here, should have stuck the close on Tuesday down towards the lows of that session. Obviously, obviously the buyers respond. Now, another key question to ask is, okay, we've already established, and it's been this way for weeks now, that stronger sellers simply do not exist in this market, but what about the buyers? The buyers really didn't show us the greatest display of strength on today's session, just going sideways. Once again, this opening drive to the upside was pretty good. We had this decent momentum breaking out of an opening range. As a matter of fact, let's go on down to a 15-minute chart here. There's your opening range. Let me zoom in on this a little bit. Here's your opening range, momentum break to the upside. Is it possible that the buyers could have produced a higher low and then a break of the 2-day high here for that move we just talked about on the daily up and over 507? Of course it's possible that the buyers could have done that, but it didn't happen. So even though we don't have strong sellers, I would make the argument that the buyers are seemingly a little bit tired here as well, and it's not so clear that it's just totally bulls on parade as this pullback is taking place. Now again, remembering the overall context of the market, I certainly don't think, and I wouldn't suggest that we want to be aggressive shorts down here, but the understanding is that stronger sellers simply do not exist. The buyers are maybe taking a little bit of a breather, and for that reason, understanding this dynamic will help us understand what we should do on a given gap situation for tomorrow morning's open. If we gap up and out of the range, I would really be thinking about possibilities of gap fill reversal. Why? Because the sellers are weak. This is inventory correction. If the buyers can step up, if they're like, hey, this is the catalyst we needed to get us in gear, great. We've already talked about how this is a double bottom potentially. Neckline at 507, holding over it for support. Great. We're looking for a move in the upward direction. The other opportunity is just a gap and go, and for that, we'll bring out the green crayon because that's about as bullish as it gets, right? Now, why would a gap and go be a primary situation on a move higher? Because we've already established that we do not have stronger sellers in this market. If they're not willing to close the gap underneath, there's nothing wrong with a gap and go in the upward direction, looking for that follow through into new all-time highs, right? So those are your gap up points of view. If you were to get a gap down tomorrow morning, my top of mind situation would be a fade of the gap and then reassess. I don't think that we have stronger sellers here based on the interaction from Tuesday again, and we'll see this on the internals as well. It's really not a stronger sell side implication there. Maybe gap fill reversal, but possibility for a higher low, then battling for acceptance back inside of range. That would really be more top of mind. If the PCE print comes in and it's just a huge miss, oh my goodness, inflation is reaccelerating to the point where, Jerome Powell might even have to consider, instead of pausing, maybe even an additional hike into the end of the year. Oh my God, the world's going to come to an end. That's where you're dealing with your gap and go to the downside. So if the sellers are going to get something that looks like this to fade the gap all the way into the end of this week, if that big move is really coming around the corner, then core PCE on the month over month probably needs to come in at a 0.4, a 0.5, a 0.6. If it comes in at the expectation, which is actually a 0.4 technically, so it's got to be 0.5, 0.6 or worse to get us this big downside NVIDIA gap fill. If it's at a 0.4, if it's at a 0.3, if it's anything less than the expectation, this is certainly not top of mind. Not really thinking that we want to go for a full gap close. And it's probably more likely that you would try to align with, let's just say that there's a little bit of downward pressure on the morning session, trying to find buyers here at the 503. So I think we've been very straightforward on what the situations are with the gap. I know we've covered a lot of different ones, but you can see where the preference is. You can see what we would prefer to align with, where the bias kind of is based on stronger sellers simply not being here. You would need an extreme miss on the PCE print if you're aiming for one of these down below. It's really got to be bad on PCE if the NVIDIA gap is going to close. All right, so that's what I'm thinking here on the hourly. Let's jump on into a couple of VWAPs intraday. And what you'll notice is great confluence there at 507. Probably don't want to play, death by 1,000 paper cuts, just getting chopped up in the midpoint of this range. Called it the meat grinder in the Discord today. That one got a couple of laughs. So this, get us out of it, get us over the anchored VWAPs, gap us over, and then gap fill reversal to the upside, gap and go clearing those anchored VWAPs. That's good. But 507, you really want to clear that for stronger longs. If you're going to get a breakdown, you are getting some support at that 503 based on this intraday anchored VWAP, right? So that is making sense for confluence there. Then the last thing we'll do is bring out the Fibonacci's from the bottom of the move up to the top of the move. And as we know, the 38.2 is loosely, not perfectly, but loosely aligned with 503 acting as beautiful bull flag consolidation. If you were to look at it through the lens of this, there you go. If you get that gap down tomorrow, but yet we find buyers over 503, we're battling back in here. It's bulls on parade looking for this flag to resolve in the upward direction. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right hand corner. What we really want to focus on are the Tuesday internals for the reasons we just discussed on the hourly. Remember, we said that we broke down through Monday's low, made a new 2-day low, but then the buyers responded with a close back in the upward direction at the highs of that Tuesday session. So what happened there? Well, volume flows were certainly into the market, even though the market broke down earlier on in the session. The advanced decline line opens in positive territory. I would concede, of course, this is a downtrend intraday, but it never flips to negative by the time the close comes around. And the cumulative build, although yes, it does flip to negative into the close, it's nowhere close to substantial. Remember that substantial reads are negative or positive 5,000. So it's just not there. We don't have any evidence of stronger sellers based on that Tuesday mid-afternoon breakdown, right? Really, it's the end of day rally that shows us that buyers are trying to at least step up here, but the breakdown is just not backed at all by stronger sellers entering this market. So again, playing devil's advocate, do we have stronger buyers? We know based on the lack of breakout today, the answer is no. The volume flows were mildly out of the market. The advanced decline line is tangled at the zero line, and the cumulative build closes closer to flat than anything else. So once again, it's not that we have buyers ready to rock and roll to the all-time high, but the stronger sellers on the one opportunity they did have, the Tuesday breakdown, certainly did not come out with any strong display of strength. Market profile is always exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right hand corner. What do we see in terms of value area and point of control? Here's Monday, here is Tuesday, and here is today's Wednesday session. Slowly moving in the downward direction, but one of the interesting things I really want you to pay attention to here is that the point of control from Monday acted as the resistance from Tuesday. So remember back to what we say when mechanical levels are set, what would this imply about the market? It means that short-term traders are in control. Just like we have short-term reference points to the downside, we have the same thing to the upside. If stronger buyers were truly getting involved, let's use the flip case of the scenario we talked about on Saturday. If JP Morgan gets an order across their trade desk to fill, let's say hundreds of thousands of ES contracts, they're not going to end the rally right at the point of control from the Monday session. That is a short-term day trader's reference point, if you will, not something that a large institutional player is going to be, trading up against. So to me, again, indicative here of shorter-term traders being in control. And the fact that we ended the rally right there would seemingly suggest that, okay, buyers are a little bit unsure of themselves. Again, if stronger buyers were here, we would have seen a break of that level, potentially not put in a poor high on today's session. So let's talk about that next. Today's poor high is just, you have to understand that what this implies is that all it means is we come up higher and we back away from the level. We come up to the same exact level and we back away again. It happens 3 times, right? We have D, E, and I periods all to the same one. Let's split this profile and you can see, here we go. We come up, we back off a little bit. E period comes up, tests, back off a little bit. Same thing in I period. So if you had stronger buyers who are willing to hold through a potential break of the previous high of day earlier on in the session, you're not going to have them selling at that high of day. Once again, this speaks to a lower confidence market, even on the buy side. So once again, stronger sellers getting involved? No, but we have to balance the analysis by also saying and acknowledging that we also don't have the strongest buyers here. But what's the underlying theme? The daily trend is up, the weekly trend is up. It's certainly possible for a daily higher low. There's no suggestion of stronger sellers, so the prevailing winds are in the upward direction. I think at the end of the day, we're trying to align with the higher time frame uptrends, but waiting for that moment to strike once a catalyst can get us out of this back and forth range. Changing gears to the QQQ NASDAQ 100 on the daily time frame chart, what do we see here in terms of trend? It's definitely more convoluted and maybe balance-esque, if you will. Sure, we technically have lows, higher lows, but remember from here to here you had a lower low. Now there's the opportunity for maybe a higher low over the top of the NVIDIA earnings gap up. From here to here you had a lower high. Now we have a higher high. It's technically a higher high from back here as well. So are you in an uptrend? Are you in a downtrend? Are you in a neutral trend? I think it's fair to say it's a little bit more of a mixed bag here on the NASDAQ, and you're also getting weaker daily structure if we think about the bars that have printed out. Sure, we got the hammer candle, the dragonfly doji, if you will, on Tuesday, but look at today's follow-up session. Instead of a green inside bar, it's actually a inverted hammer, suggesting that sellers stepped up at the low of the Monday session, rejecting that level and closing weaker near the lows of Tuesday's session. We'll dive into the nuance on the hourly in just a second, but on the daily chart, let's talk about where ideal, picture-perfect higher lows could form to continue the possibility of an uptrend, right? Let's count it from here. Lows, higher lows. Ideally, higher lows are here. We do not dip a toe into the NVIDIA earnings gap up. That's at 433.75. Can we find buyers here tomorrow? Does PCE yield some sort of gap up? Then we're back in the upward direction. Great. We've got ourselves a daily higher low. If we look into the gap, really want to see support happen here at 430. Is it possible that you could go all the way for a gap fill reversal, a prompt one, a sharp one, just like the S&Ps, and still get some sort of higher low from here to maybe in here? It is absolutely a possibility based on the technical perspective of the chart at 425.75, but let's just remind ourselves of the importance of 430, right? Previous rejections back here, all of these rejections, we broke out once, we failed back down underneath. The buyers were given a second opportunity, they failed it once again. They're given a third opportunity. If they fail on the third opportunity to produce a higher low over 430, which is not a full gap close, right? It's a partial gap fill reversal holding up over 430. If the buyers do not step up here, I would likely start to think that it's much more possible for some sort of weekly double top. You're underneath that breakout point. Why are the buyers failing to really yield that higher low over a key structural area? I would just disassociate. I would say I don't want to be an NQ bull anymore if we're underneath that 430. It doesn't really make sense that we're unable to produce that higher low that we've been ranting and raving about at 430. In the NQ futures, if you tune into the live streams, you know that that level, we've talked about it day in and day out, is the 17.7s level. You've got to hold 17.7s. You've got to hold 430 here in the QQQ. Once again, like the S&P, is it possible that then you get some sort of lower high risk underneath? It absolutely is possible, but one step at a time. For now, I would watch to see what the reaction is at 430 on an adverse reaction from PCE. Anything that's underneath, again, technically speaking, sure, higher low from here to here, but I would be thinking about bear flag consolidation. You know, the odds would dramatically increase for a lower high underneath 433.75 if we break and do not hold this area. So 430 is top of mind if bad things happen into the end of this week based on some fundamental catalysts. It's also the lower edge of this week's expected move baked in there at roughly 429.18. Let's move on. Actually, let's talk about upside before we go to the hourly. Obviously, breaks and higher lows over 438.50. It's rock and roll blue sky territories overhead. Upper edge of this week's expected move could act as a potential target for 44.34. Let's move on down to the hourly now and see what's going on from this point of view. So just like the S&Ps, you can clearly see a balance range, a little bit more defined actually in the NASDAQ. So no surprises today that opening underneath, we had the opportunity for a lower high. Why? What's the reasoning behind that? This is all overhead supply. Anybody late to the party trying to get in on the long side who wants out for a break even, where's their best selling opportunity? Right there on the retest of the lows at 436.40. So definitely in a stronger hourly downtrend here. We closed the day out underneath this as overhead supply. So any consolidation in here, thinking about breakdowns, if we can get back in here, great. We will be patient. I would not want to get caught up in the meat grinder inside of this consolidation zone. I would be patient for the higher low, as we discussed on the daily, up and over 438.50. Now, what do we know? Again, PCE is very likely to cause some sort of gap. If the gap is down into this range, I would tend to think, because the NASDAQ is a little bit more bearish than the S&Ps, I would tend to think this is more of a threat out of the NASDAQ and then the stronger retest of 430. This to me would be top of mind if PCE is a miss or if it just causes a gap down in the first place. So opening below 433.75, looking to close the gap 434.65, today's low of day, then rotating back in the downward direction to test the key level on the daily at 430. That is top of mind to the downside. If we gap up into this range, higher lows over today's range kind of isolates that to the downside. So any aggressive sellers thinking, aha, this is the moment. We've broken down from the overhead supply. We're going to finally stick it to them. No, no, no. If you gap up into this range, find a higher low over 436.40. Again, not thrilled about getting involved in there. However, would speak to the improved bullish odds of a break for new all-time highs. So that's really what I would be watching for. Obviously, any gap ups over here, gap fill reversal, top of mind, 438.50, higher lows, good to go. If they're let's just play it out, Armageddon. If we open on a gap down underneath 430, I think there are larger issues that emerge in this market, and we probably do something like this. Start looking for a stronger leg lower on maybe something like the weekly time frame chart. Once again, we'll take that in stride, but that's a possible situation on a gap under 430 with a huge miss out of the PCE inflation numbers. Let's go ahead and throw on the anchored view apps intraday, see if these are offering any confluence. We'll take a look, barreling in towards this 436.40 area. So bears kind of have a little bit of an edge underneath if we get a more neutral open, which again is technically a possibility, but we'll see. I would tend to think we get range expansion on a catalyst like tomorrow. If we can clear that 436.40, again, kind of the meat grinder in here, wouldn't want to get involved, but definitely more bullish than bearish. This is your entry with the added confidence that the view apps will support you to the backside as they start to curl back in the upward direction. If there's a stronger break, obviously moving into the gap, this is not going to do much for you if we're opening down here. Gap fill reversal is top of mind, rejecting that VWAP if it's going to continue to drift slightly in the upward direction. Anything with the Fibonacci's, then we're going to take a look at the internals for the NQ side of things. Yeah, beautiful 38.2 at the beginning of the gap, so 433.75 is that 38.2. Anything up here in the grand scheme of things is just hourly consolidation. So again, don't jump the gun on the short, but I do think it's more of an opportunity for a short in the NQ and the NASDAQ side of things versus the S&P. That is for darn sure. Let's take that back off and move over to our internal side. You can see that we had slightly stronger volume outflows on today's session. However, again, play devil's advocate. On Tuesday, we had stronger volume inflows. We did get substantial here on Tuesday, up and over 400 million, whereas the S&P did not, but this is more aggressive to the downside. Certainly not substantial, but more aggressive than what we saw in the S&Ps on a relative basis. Same thing with the advanced decline line here being well underneath the zero mark on this side, and the cumulative build is more one-sided instead of two-sided out of the S&Ps. The S&Ps had something that was a little bit more so like this into the close. So bears, again, a little bit more of an edge on the NASDAQ. It's been that way for a while. We know that tech is notoriously going to be more rate sensitive anyhow, and if PCE comes in hot, like just for those of you who maybe have not connected the dots all the way, which again, there's nothing wrong with that. Everybody's at a different point in their journey, but a hot PCE suggests that Jerome Powell has some work to do with getting rates either higher for longer, maybe another hike, dare I even say that, or just no cuts at all into 2024. In terms of the market profile on the NQ side of things, notice that on Tuesday, the value area and point of control certainly migrated higher, and this supports the bearish thesis. You're like, wait, what? This suggests that, there were participants at the highs. You're absolutely right, it does. And notice today that the high of day is underneath the value area low. So what would that suggest? All of these buyers are dead underwater, putting more downward pressure on the market, which is one of the things we talked about in the pre-market prep, right? We were opening underneath. If we just go back to the candle charts, we were opening underneath the previous day's range here, overhead supply weighing on the market to the downside, being confirmed with the actual volume at price here from the market profile. As long as we're underneath, I would argue this value area, which is, let's loosely call that one 17,975. As long as we're underneath that, as long as today's high of day holds as resistance, I would tend to think that the overhead supply will continue to weigh on price in the downward direction, threatening more of a move into the NVIDIA earnings gap up. And lastly, for the broad market indexes, we have IWM Russell 2000 and the small caps on a daily time frame chart. This is a very interesting chart. It's not nearly as stagnant as what we saw over in the S&Ps or the NASDAQ, and it's actually looking constructive in the upward direction. We, of course, had a gap up on Tuesday, and that gap up brought price to the top of the volatile range box. Remember that the volatility really kicked in over here, but we're back up towards those equal highs, and even the weekly equal highs near 205. So if we can break out over 205, and we'll talk about how that's achieved in just a moment, remember that a weekly breakout here speaks to the concept we've been talking about for the past couple of weeks, which is the broadening nature of the broad market rally via more participation, aka small caps getting involved. So if you see the IWM breakout over 205, very constructive signal for the broad market as a whole. Now, how do we actually achieve that? Because the daily chart, again, I don't want to call it overextended, but there was a nice move to the upside. Digesting some of the gains is not unreasonable. Now, most of that gap has closed on today's, upper wick rejection, went back down towards the high of Monday's session. But if we can hold that Monday high and bring in consolidation that looks like this, there's your daily bull flag at the top of the volatile range. Breakout from there is looking good. You could participate on higher lows over 205 for a retest. That's really the best looking way I can see forward out of small caps here. The sort of continued line in the sand, though, and this has been a long-standing issue for the small caps, is that we need to find acceptance over 199, right? And you can see that if this is going to act as your daily double bottom, this was a very sloppy pullback. We technically flirted with acceptance underneath, kind of pushed back above. This move to the upside is constructive in the sense that it now gives us a stronger opportunity for a weekly higher low above that level. If you're counting daily lows, we have lows, higher lows, higher lows, higher lows, possibility now for higher lows at 199. And because of that, it's a line in the sand, right? We really don't want to go back down towards the midpoint of this range, but if we do, you've got to stay above it. You really want to stay in the upper 50% if we're looking for that constructive weekly breakout. And once again, that would act as a tailwind for our S&Ps to continue in the upward direction, or at least prevent a larger breakdown if the NASDAQ is going to move in the downward direction. Let's take a look at the hourly time time frame chart and see what else we can learn about the price action, whether or not there are any little intricate indications here. Not much. I would just say that this reversal off of the high of day from today is just interesting in the sense that we were not able to produce a higher low inside of Tuesday's range. Like, again, thinking about if stronger buyers were truly here, if everything was firing on all cylinders, why was this unable to stick near these highs? Like, why couldn't we have gotten some sort of flag consolidation, maybe attempted to break into the afternoon? That's fine. It didn't have to break into the afternoon, but this equal low kind of into the end of day leaves a little bit to be desired. So early on tomorrow, again, depending on PCE, a couple of interactions here on the retest of 201.50. In a picture perfect world, there's an open inside of range, and then we get a break, or we get a break, and that's going to help us learn something about the market. If we open on a gap down tomorrow underneath 201.50, it's likely because PCE was severely hot. Remember that small caps are always going to be more sensitive to economic data. So if we're opening underneath 201.50, I would tend to imagine that we need a retest of 199 for a stronger daily higher low, right? We flip into an hourly downtrend. We have highs, lows, lower lows, some sort of lower high, something that does this, test of this, and then if we can get the hourly trend reversal via double bottom, via some sort of inverted head and shoulders, simple hammer candle down here, whatever it is at 199, there's your daily higher low, and then we're trading back in the upward direction. If PCE comes in fine, it's a non-issue for this market. Let's say that it even comes in better than the expectations. Remember, CPI was hot. We have a number of things pointing to a hot PCE. But let's say it does come in better than the expectation, and we open on a gap up. Great, we're one step closer to that weekly breakout that we were just describing. Let's check in with the confluence in terms of anchored view apps as well as Fibonacci's, and what we can see here is a number of them are going to start acting as support near that 201.50, so just reinforcing the idea. Picture perfect consolidation there. Let's bring out the Fibonacci's from this low up to this high, and lo and behold, you can't make this stuff up, guys. 38.2 right to the level as well, classifying it as healthy bull flag consolidation, looking for continuation over time as long as that holds. Again, 201.50 and 199, your major lines in the sand into the end of this week. Let's take a look at the internals for the Russell side of things. Let's fire these up here, and you'll see some stronger volume outflows today paired with stronger volume inflows on the Tuesday session. Remember, Tuesday was the gap up. Today was the reversal off of the high of day. Morning session was good, afternoon session not so much. Remember, or I shouldn't say remember, but notice that today we opened in trend lower zone, battled back up through or to the zero line, didn't really puncture back down towards the lows out of the advanced decline line, which is interesting. The cumulative build on the tick is also fairly flat. It's not nearly as aggressive in the downward direction as it could have potentially been considering the magnitude of the reversal off of this sort of mid-morning high, and then everything was lower into the afternoon. So if we're thinking about the strength of buyers and sellers, doesn't seem as though, even on this leg lower, we had a very impressive show of hands from the sellers, right? It did not become reflected in the cumulative build. This did not roll all the way back over to the trend lower zone. Again, I want to concede that, of course, we weren't positive on the day. This is not a good look for the buyers. This is not a good look for the buyers, but it's not nearly as bearish as it could have been. So in terms of small caps, I think that the participation is trying to align with, great, there was a pullback. Great, there was an expansion of range in the upward direction. This move to the upside is kind of what kept the S&Ps afloat in the opening range on this morning's session as the NASDAQ initially broke down, right? So the rotation is still alive and well. It seems as though we can be constructive out of small caps, which the whole point of this story, the whole point of walking through small caps is just to understand how much risk there ultimately is in the S&P. Small caps are performing fine, then we're not looking for Armageddon out of the S&P 500. Here is the market profile. Then we'll get into the sectors. What do we see, right? So higher on the Tuesday session via the gap up and go, and then lower on today's session. So is this overhead supply? Certainly. Could we find support? Could we find buyers on the retest of this sort of Monday high gap fill reversal? I think it's likely. Notice that the value area in here, if it's going to be defended, coming into that, looking for buyers, keeps us bullish based on everything we've just discussed over on the candle charts. So let's take a look at the weekly performance of our S&P sectors here. Who was leading, who was losing, and where was the weight? The XLY, consumer discretionary, was up at the top of the pack here, up 0.74%, 0.75%. Solid display of strength considering that the XLY is more of a risk on and a heavier weight sector, fourth heaviest weighted sector by market cap. It's followed up, though, by utilities, real estate, and materials. Utilities are D for defensive, and all of those other sectors are lightweight sectors. It's not really what you want to see as you're pushing towards a new all-time high. But wait a second, I just said pushing towards a new all-time high. Is the market doing that, or is the market pulling back? The market is certainly pulling back here. So the positioning, the rotation, the posture seems fine to me, considering the pullback that is underway. And also, if we think about this, is it all that surprising that we didn't go for a break of the hammer high? noting the posture here? Not really, right? So all good in terms of what's leading. At the bottom of the barrel, it's the SMH semiconductors down 1.5%, a little bit more than 1.5%. And although it's not directly an S&P sector, begs the question, like if semis are down 1.5%, and we know NVIDIA is the one stock to rule them all for the S&Ps, but the S&P is only down 0.4%, then I really think it does speak to the importance that the IWM and small caps play in terms of this rotation role we've been talking about. The XLV is the next up in terms of bottom of the barrel, down 1.19%. Then it's communications, also a heavier weight risk on style stock, sector. The XLK, the tech sector, is down 0.72%, and we're also, and when I say we, I mean the S&P, is also outperforming the TLT. TLT is down about 0.5%. The S&P is down only about 0.4%. So let's take a look at the structural charts, evaluate what's going on here. Also, let me know, do you like it if I include the S&P here? The list grows a little bit, but I think it's great to look at it in comparison, at least on the weekly performance in this particular window. So let me know down below in the comments. But anyways, XLY, any issues with the chart here as it leads the pack in terms of posture? Absolutely not. Breaking towards highs, breaking out of this range, getting continuation in the upward direction, pull back higher lows are certainly on the table. No issues from a structural point of view. Fine, good to go. That is bullish. Here's the XLU. It's towards the top of the list, but do we see any outperformance issues here? Absolutely not. This is still not even triggered as a double bottom. You're not even close to the, maybe you are close, but you're not threatening a break of the neckline yet. Could that change with a hot PCE and a flight to safety? Maybe tomorrow morning, but we'll keep an eye on it. I'd really be concerned with utilities if we start getting, like, let's say a huge gap up over 63, over the 200 SMA. We're getting price acceptance out here in utilities. Okay, red flag is going off. In my head, why are utilities outperforming this way? As of right now, kind of a non-issue as it just consolidates inside of this as a larger range. Next up, real estate. Any issues here? No. Lighter weight sector, maybe a bit more deep for defensive, right? Go out and buy some hard dirt. It's a hard asset. Great. Not much going on. Break 39, upward pressure is upward pressure. It's not falling off of a cliff, which is certainly indicative of rates remaining tame. So all good there out of real estate. Next up, XLB materials. The lightest weight sector we have, breaking to the upside, bull flag consolidation, bullish engulfing bar on today's session. Any issues? No. If it breaks down, if it looks for a higher low, weekly higher low here over the daily 50 SMA in blue at 84, good to go. Lighter weight sector, it's only going to become more of a downside concern if this fails at the 50 SMA, or, heaven forbid, over the span of one day, it does something like this. We'd really have some issues on our hands, but all good here out of XLB. It's a lightweight sector. Let's move along. XLI, new all-time highs. Anything bearish to say about the chart? Absolutely not. Weekly higher lows, daily higher lows, trend continuation, bulls on parade here. XLF financials, really pleased with this chart, right? We had talked about this compression of range. The breakout is sticking. Now we're getting higher price acceptance up here. Ideally, the next leg is up and over 40.40. That, of course, would continue to speak towards a more bullish market compared to a bearish one. SMH, how bad is the 1.5% move to the downside? Oh man, it's the end of the world. Look at this chart. It's going to go to zero. Absolutely not. I mean, look at this thing. It's just consolidating at the all-time highs. It's over the earnings gap up from NVIDIA. If it dips a toe into the NVIDIA earnings gap, it can find a higher low at this structure here, $200.85. I mean, really, you've got to produce more damage if the market's going to tumble. I'm not seeing the evidence for it as of right now. The structural chart looks fine. Again, could PCE shake things up tomorrow with a hot print? Absolutely could. Where would the biggest concern step in out of the SMH? Price acceptance down here near the equal low, 196.25. If we get a gap down to here, okay, larger issues. Why did we just unwind the entire NVIDIA earnings move over the span of a hot PCE, right? Really not ideal. If it's a mild gap down to like here, we go gap close and then maybe pull back a little bit and then fight back to this range. Nothing bearish to say about the chart. If there's a gap up, speaks for itself, bulls on parade. Next up, XLV. Healthcare sector, second heaviest weighted sector by market cap. As we know, it is D for defensive though. So what do we see? Again, uptrend, healthy pullback here, hammer on today's session. If it breaks that hammer high, looking for upside, because it's the second heaviest weighted sector, great. Your S&P is not going to fall off of a cliff when the structure looks like this. Bulls on parade, even on the two charts that are technically at the bottom end of the barrel. XLC, any issues out of this one? Yes, there is an issue here in the XLC, and it's just the price acceptance near the bottom end of the range. If you split that range in half, all of the acceptance is sort of underneath. Today was a bearish 3-bar play setting up, where if we crack these lows, longs late to the party, or all of this just turns into overhead supply. The idea is to close the gap underneath. So, is there a bearish setup out there? Absolutely yes, on your XLC. The chart does not look great compared to all the other things we've seen. However, let me just remind you, if I zoom this chart out, is it possible that the weekly chart gets a higher low here? Yes, it is definitely possible. Is the 50 SMA aggressively sloping higher? Is the 200 SMA aggressively sloping higher? Yes. So give yourself the context that sure, If we break down from this range, it might provide intraday bearish pressure, but everything else that we've already looked at on the list does not seem to be a large threat. So is communications enough to tear down the market, from the highs? It would seemingly, to me, it would seem like no. Let's move along and talk about the XLK tech sector. Lower high, equal high potentially on the table. Back down inside of this as a range. Larger concern? Yeah, it doesn't look great. In a picture perfect world, this gap would just sort of have yielded higher prices in here or some sort of more meaningful higher high. It's not the end of the world though. Again, the bigger concerns, larger concerns out of the XLK, probably you're talking about moves down here to the daily 50 SMA. You're talking about closing the NVIDIA gap all the way, price acceptance underneath the NVIDIA gap. It's just not there yet. Is it possible that the market needs to digest this overall move? I think the answer is yes. Let's move along to the TLT. We'll talk, structural chart's fine. No concerns there. We'll look at the ratio in just a moment. Here's the S&P we already talked about. XLP, that's the one thing. If I am going to start including these things in the list, I've got to adjust my walkthrough. But the XLP, we've got ourselves decent looking uptrend. I mean, obviously, if you were to throw on a channel here, this could probably go in a textbook, right? Probably could go in a textbook. There it is, midpoint of the channel. Continuation, fine. Breakdown, fine. Catch yourself for a daily higher low. It's a D for defensive, lighter weight sector. Not concerned with what's happening here. If for some reason the S&P as a whole starts to push to new all-time highs and it's being led by an XLP that's pushing 76.25, okay, posture issues start to emerge because it's D for defensive. But as of right now, pulling back mildly with the broad market, not really an issue. Last but certainly not least is the XLE energy sector, trying its hardest to break out of this as an inverted head and shoulders. But notice we're just getting consolidation in the range. So if we're thinking about inflation and it may be re-accelerating, does energy seem like it's going to be a huge player here? Unless it's energy services, the XLE is not really showing us that, oh my goodness, gasoline prices are suddenly going to start booming. We'll take a look at that chart in just a moment, but for now, let's move into the ratios. So here it is. Here is the grid. If you're not familiar with how to set this one up, check out the video tutorial in the top right-hand corner. What do we see? Risk on, risk off. XLK, slightly concerning, rolling over on the back test of the 50 SMA. If that continues to unfold that way, a smaller red flag starts to emerge for the market, but notice that the XLF is playing pickup. It's grabbing the relative strength up and over now, the flattened out, maybe even upward sloping 50 SMA for a higher low. So that, I don't want to say it neutralizes one-to-one what's happening with tech up here, but it's certainly helping. I would argue that the combination of the XLF and the XLY, this is now maintaining a bit more of an uptrend. Remember, we were slightly concerned with the stagnation. The fact that it's now performing back to the upside, I'd say again that this combination kind of outweighs or at least evens out the small concerns out of the XLK. XLV moving back in the downward direction is healthy. Remember that this is D for defensive, although it's the second heaviest weighted sector. XLI looks good, perking up here. XLC, can we find buyers on a relative basis over the 50 SMA? I would be watching out for this one here. We talked about the concerns on the structural chart, though. It doesn't look great as long as the XLF, so your big performers into the sort of next wave of this move, if you will, are either going to be these two here, looking for continuation of these constructive looks, or a reversal out of tech to recapture the 50 SMA. I would say that the XLC has already ran its course with this move ahead of, primarily meta earnings, right? As we know, XLP, not really a concern, not a threat for risk off. Same thing down here with the XLU. So we're moving along to some specialized ratios. These are very simple today. Stagnating, nothing special, does not, indicate that we have stronger sellers around the corner here. So far, so good. More of a risk on sentiment than risk off. Certainly same thing here in the XLK, starting to become concerned with the head and shoulders, certainly, but it would require the breakdown of that neckline, require the breakdown of the 50 SMA, and then of course, red flag, we'll bring it to your attention, but as of right now, good to go, just consolidation until proven otherwise. Let's take a look at the XLY XLP, and this of course is more apples to apples, loving the higher low, loving the attempt at the top of this most recent little range over here. If we could pop that to the upside, beautiful. That of course would speak to a stronger risk on sentiment, apples to apples here, versus something like your XLK SHY. Here's the SMH XLV, a newer one to the sort of lineup, and notice the opportunity for a strong higher low, a little bit of stagnation near these highs. However, certainly, nothing that's going to jeopardize the trend just yet. We would be concerned if we break down, more importantly, underneath roughly this 1.3. The ratio might be different depending on the data providers that you have. Let's continue along to our dollar and see what's going on. So the name of the game out of the sectors is still risk on. What do we see here out of the dollar? A little bit of upward pressure earlier in the morning, but it's quelled into the afternoon, and we're more so just sideways in the dollar. Is gold showing us anything interesting here as a heads up to the dollar? Not really, still sideways in this range, but what about silver? Silver is the one that rules gold, at least recently. And we can see, okay, so silver might be a little bit more interesting, starting to forecast, all right, if silver breaks down through the bottom end of this range, because remember, this primary idea was double bottom neckline. You've got to get up and through that. Then we're looking for continuation that puts downward pressure on the dollar and therefore upward pressure on equities. If we get this breakdown out of silver, though, because we have failed the double bottom, and notice that this even broke down over here. So you had trapped sellers. If there was ever a time to break this neckline, it was right here. Did not happen. So now that we're back down towards the bottom end of the range, the gift just keeps getting passed back and forth, back and forth. I would say that the sellers have the upper hand at the bottom end of the range, noting the interaction here with the lower low and the failed break of the neckline. So if this is lower, obviously that means dollar is maybe slightly higher, and therefore downward pressure on equities, yielding some sort of move into the NVIDIA earnings gap. So watching for that as a relationship specifically around PCE and what the fundamental data looks like tomorrow morning. Let's take a look at interest rates. They continue to just shy away from that 4.33, which is technically good for our market bulls. But notice it's consolidation. We're really putting in an opportunity for a higher low here. If that breaks, much larger concerns with the market. We haven't done it yet. The market's showing us it's very uncomfortable trying to make a move up and over 43. Every morning we check in. It's like, okay, TNX is backing off. TNX is backing off. Great. We're underneath 4.3 in the 10-year. That's good. If you're a broad market bull, you want to see that act as a major lower high on something like a monthly time frame chart. Let's just go out to it so you can see it. Here we go. So previous resistance. There was also resistance here. There's a little bit of support. You would see that on weekly or daily. Then you want to see that act as a lower high now. Again, 4.3 is your big line in the sand out of the 10-year. Let's move along to the inverted ZT, see what the 2 years showing us still just higher for longer. There was a contract reset today, so we'll take this in stride going forward. So let's just jump on over to the Fed tracker tool. So there we have it. No major changes to the tracker tool. Still expecting 1, 2, and 3 cuts into the end of 2024. And this is subject to change tomorrow morning when the PCE numbers come out along with the unemployment claims. I would have thought that these probabilities would have adjusted more so based on the durable goods orders, which came in abysmally on the Tuesday morning session at 8:30. I mean, negative 6.1 when the forecast was for negative 4.9 prior at negative 0.3. Goodness. I mean, yeah, you do have some seasonality aspect to after the holidays, maybe people buttoning up spending, but just not there at all in terms of higher ticket purchases from consumers. As we take a look at the GDP numbers, I mean, still above trend growth here at 3.2, minor revision in the downward direction. If you take a look at the GDP tracking tool from the Atlanta Fed, I mean, so far so good. This is well above the consensus, above the estimate, above 2%. You're not really going to get a Fed that's panicking if GDP is still above trend. Now, granted, they're never ever going to come out and explicitly say, hey, we've got some sort of mandate or we're concerned with GDP. It's outside of their mandate, actually, and they're only going to talk about price stability and maximum employment. But you have to imagine that Jerome Powell, a guy doesn't live under a rock. He's not as dumb as everybody says that he is. Core PCE, what do we have? 0.4 is the expectation for tomorrow morning's session. And if we take a look at the previous cycle of PCE, I've got it up here. Notice that the largest contribution came from services. Services, and this was back in September. There was your largest uptick. And as we continue to look through goods have continued to deflate over the months here, as you can see in these number of windows. So if we're thinking about where this number is going to come in, probably means that services need to come in hot or energy needs to come in hot. Energy goods and services, you can see here, ticked higher on the December, and for that particular September read where services were hot, you'll notice that energy services were 1.7, prior with 6.1, so you're coming off the heels of a very hot energy market there, no pun intended. So what does gasoline look like? Just as like an input, as a raw input, not so much the services side, but this is what we're looking at. The first of the year, because remember, this is January's readings. We get January in February. And January 1st is like right around in here. January 31st is right around over here. So is there material increase in, the gasoline price over this time horizon? Absolutely. So we are going to be watching out for that. It's worth paying attention to. But I think the larger increase that maybe people are concerned with, which is this breakout in energy here, that's going to show up in the February read. And you better believe that the market is, the market can see this. The market is multifaceted. It's multidimensional. The equity market can see that gas prices are higher. It doesn't really seem to be concerned. It's more so involved in the NVIDIA story. We'll see if it snaps back to reality. But overall, everything that we're seeing here would suggest that, okay, inflation may tick in the upward direction, or it may come in hot, But the market knows this. The market knows everything that it's about to get, or it should know everything it's about to get, unless there's a surprise, which is why the downside surprise is the danger factor for that larger gap fill to the downside we talked about in the S&Ps. Let's take a look at the remainder of the earnings calendar into the end of this week. SoundHound is interesting, right? SoundHound and the NVIDIA stake that they have in it, they report Thursday after the close. Same thing with Dell Technology, not so much on the NVIDIA stake, but Dell after the close on Thursday does the dinosaur perk back up the stock chart. If you just take a look at it, it's actually very impressive to the upside, so don't write off Dell. Not interested in any of these EV stuff, Plug Power there, Fubo TV, all these things were kind of like hit and miss 2021. Let's leave them back there in 2021 and move along into the remainder of our analysis. Risk appetite still looks fine. TLT ratio to the S&P sitting on the lows. No flight to safety trade unfolding over here. Bonds in relationship to themselves trying to put in a lower high. Notice that this is just rolling, but in the other ratios, we do have the opportunity for a lower high. Everything starts with a very minor and subtle shift. Is this going to continue to make a move in the downward direction is the next key question. If it does, that would speak to more of a risk on appetite for equities down below. Not that it's already not risk on, if you will. Let's take a look at the credit spreads, and these of course just remain flat and stagnant. No issue in terms of credit event around the corner, and we will take a look at the HYG in isolation, which is still divergent. So you can see that there is a break of this trend line. Yes, there is sort of an equal high to back here, but just remember that the market has gone for another higher high, where this is still technically a lower high from here to over here. So not all the way there in terms of being back in sync, but it's certainly not suggesting Armageddon. The Armageddon steps in when the HYG breaks down underneath, what is this, 7650s? 7650s. If the HYG breaks down here and we're still divergent pushing to the upside in equities, okay, what's going on? A little bit too disjointed, looking for a correction, even if it's just a minor pullback, right, out of the S&Ps down below. Let's move along and talk about Bitcoin. The digital gold is absolutely ripping and roaring to the upside. Everybody's hooting and hollering over on social media. The old Bird app is going wild. There's a breakout in Bitcoin. What would that mean for equities down below? Obviously more of a risk-on indication, right? If people have spare cash thrown around in Bitcoin, the market's not going to go to hell in a handbasket. I mean, we're not talking about people, begging for bread on the side of the road when Bitcoin is breaking out to the upside. So anyways, that is a risk-on indication. Let's move along to our breadth indications. New highs versus lows. Although it's pulling back, it's still positive over the zero line. Same thing can be said here in the SPX A200R, remaining somewhat flat. Pulling back mildly, but still in the consolidation, if you will. And then following it up with the SPX A50R, still off of this low, trying to get some lift in the upward direction. RSP has been our sort of sweet spot for the equal weight and just remaining risk on across the market, right? When we're talking about, literally breadth of the market, it's fine. Like anybody who's telling you that NVIDIA is literally the only thing running the stock market has not looked at this chart. I mean, how many times do we have to cover it over and over and over again? It's not just NVIDIA, the one stock through them all. Is it important? Yeah, absolutely. I would concede that point, but it's not the only name that's participating in the upside. QQQE, same thing, fine. It's actually divergent. It's got a bullish divergence to the weighted NASDAQ down below. Weighted NASDAQ's a little bit weaker, as we discussed on the QQQ daily. Look at the QQQE. It's flat sideways inside the range. No issues out of that. Let's move along and talk about the Dow Industrials and the transports. This is still mildly inside the midpoint of the range. Small and minor divergence, but certainly not enough to go out there and start shorting equity markets because you're thinking, oh my goodness, transports, it's the end of the world. Volatility is suppressed. I mean, maybe a little bit of a trend line happening here off of the December lows. You get something that looks like that, but are we up and over 15? The answer is no. What about the VVIX? VVIX is also fairly tame here. Even with the PCE around the corner, it's stuck in this range down towards complacency zone. Now, what I said in the intro is the market seems to be prepping for a big move. Remember that when we're near complacency zone, all it takes is the slightest bit of information or the slightest pullback in the market, and this thing takes off to the upside, right? You saw that happen over here at 75. You saw it happen here at 75. This, right? It takes a very little amount when you're coming from these lows. Very, very little amount when the complacency effect is in full swing to really start to light things up in the upward direction. So again, if PCE comes in hot, I do believe any selling in this market really ignites the VVIX, volatility creeps up, and then we're looking for a larger move to truly unfold in the market. Last but not least, volatility spreads. What's going on over here? Strong contangos. No issues in terms of the futures market. Same thing, 9 versus 30-day VIX. Small uptick on the one-day VIX, probably starting to price in some of the risk on the PCE ahead of the market open tomorrow morning at 8:30. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Do me a favor, hit the thumbs up button and subscribe. Is it fair to say that we're on the road to 100K? Is it that time? We're less than 25,000 away, so let's just start talking about it. Road to 100K subs, maybe by the end of 2024, we will see. But we'll kick things off with Apple and then 2 additional trade ideas after the core list of companies. So, descending triangle is in full swing. Unfortunately, we've had to cancel lunch with Uncle Warren Buffett here a couple of times. Can't be seen with a guy who's long to the gills a bunch of Apple shares. So this flush point is looking deadly here at 180.25. As long as we get price acceptance underneath 184, you're not triggering technically a double bottom, and the flush point opens the door all the way down towards 173.75. Look left on this chart. This thin structure from the earnings reversal back here is not really going to offer you much. Maybe there's a blip of something at 176.75, but imagine the weight of this overhead supply. And we know that, the sellers are building the edge. That's what the lower highs would suggest. And the buyers are just getting steamrolled, right? Over and over and over again. Every time there's an attempt to pop things, even with the good news canning the whole EV sort of department, if you will, over in Apple, it's not enough to break out over this as a neckline of a daily double bottom. Not enough to recapture the daily 200 SMA at 184. So daily chart consolidation here, I think the risk is to the downside. If we can break it, obviously you're looking for this. And then from there, I would look for a weekly lower high at the daily 50 SMA. So you can trade that for sure in the upward direction. I mean, there's definitely a long to be had there, but you want to be patient for either acceptance here, then a break, or if it's just a straight shot, look for that higher low pullback over 184, then weekly lower high up here at 187.50, looking for that reversal back in the downward direction. Maybe then the 180.25 is truly going to go. That's Apple. Let's move along to Softy. What's going on over here? It's just flirting around sideways in the gap. There's really not much going on with it. I would say that it's a patience play. You don't want to get caught up in the meat grinder here. Look at the first hourly bar of today's session. So this sets the entire range of the session, and then we do nothing all afternoon. So be my guest if you want to get involved in there, but I would prefer to wait for something that looks like this, or just get us back into the gap. There's probably a scalp that exists in here, and then promptly looking for reversals off of the gap fill at 402.75. So keep it simple in Microsoft. We'll see if the gap from PCE, if there's a gap in the first place, gives us anything interesting tomorrow morning. Google, just do not touch it with a 10-foot pole. The AI is corrupt. The company is corrupt. Should watch my mouth here on YouTube, but you get the idea. People are not pleased with what's going on with Gemini. The stock price speaks for itself. Everything's lower here. Bearish acceptance on Tuesday after the Monday sell. A continuation leg lower on today's session. If we take a look at the daily time frame, we're just moving back into this, really, really sloppy area on Google. So when I look at the daily charts, trying to see where the setup is, where's the entry point, what are you looking for? I really don't look at this chart and say, oh, good, here's an attractive entry. I'm really not seeing it. So if there's something, maybe it's going to revolve around this 135.75. If there's a breakdown, we've got some lower levels to at least pay attention to. But again, I don't look at this chart and say objectively, aha, here's a setup, here's an entry. So for that reason, we're moving along. Next up, Amazon. This, on the flip side, does have a setup here for a possible higher low over 172.35, better seen on the hourly chart. What we're looking for is the inverted head and shoulders to be in play. So it does require that the PCE does not yield some sort of gap down tomorrow. If we open in range near the highs, this is your inverted head and shoulders, and your neckline, therefore, is over 174. Breakouts over that, and you're trading this thing back in the upward direction, recapturing the inverse pattern, right? Maybe this was sort of a really sloppy head and shoulders. You've got to recapture that neckline. So 174 is your big level out of Amazon. If you can get back up and over it, looking for the equal highs around 176. If it's downside, if this is truly going to turn into an H pattern and you do not get an open in here, you get an open that's weaker towards the lows of this morning session, then fine. Looking for the gap to close underneath. Under 172.35 closes at 170.25. Next up is NVIDIA. The one stock to rule them all. Some beautiful structure on this chart. You can see clear as day. Overhead supply, lower high on today's session. Flush point is where? 773. Right? If there was going to be stronger buying activity, should have pushed into and battled for price acceptance in that range. Did not take place, and instead you just have this downtrend which is forming here. Break of the flush point. It's very similar to almost like Apple, but on a compressed time frame, obviously hourly here. You're breaking down through thin structure. So shorts all day long on something that looks like this. Through the thin structure, stronger retest of this level down below at 741.25. Reassessing when and if the chart gets down there. If it's to the upside, maybe there's a long, but I wouldn't want to again play the game of the whole meat grinder thing in here, and instead the better long is actually on a higher low over 802.85. Next up, Metaverse. Zuckerberg's Fantasyland. What's going on over here? Looking okay, but again, more of a balance range than anything else. Being patient for this. That to me is really the ideal outcome. Higher lows over 490. So far, so good. We want to keep in mind the context of being above the top of the earnings gap up range. So buyers do have the upper hand, but we just need that, we need that push. We need that catalyst. We need that momentum to bring us up and over 490 for that continuation. If it breaks down into the range, probably not looking for shorts, maybe something through the gap close. That would be a scalp, but the stronger shorts are probably just, still really patient until you're under 466. So Meta trying to maintain that bullish edge. Next up, Tesla. What's going on with Mr. Musk and the rocket ship over here? Bullish, constructive, everything about the chart looks great. If this is a trend line, we're holding it to the T. This was a range. This is a building block in the upward direction. You do have a two equal highs, or what am I saying? You have two equal highs, bar to bars, which could potentially offer a breakout here. So it's either up and over that at 206 or some sort of double top. Okay, we're neutral inside of this range. Does the trend line offer some sort of consecutive high or low, right? Let's just put that in there one more time. You can see how maybe there's a little bit more wiggle room where if you break that, does the trend line offer something? And we will watch out for it. In a picture perfect world, yeah, of course you would just support over the 198.25. So being in the midpoint, closing in the midpoint, again, leaves a little bit to be desired, but the structure is very clean. You have 206, you have 198.25 playing up against those levels as your primary outcomes in Tesla. Next up, Netflix, and then we're into two additional trade ideas. Then you're on your way. Can you believe that? You are on your way just like that. So Netflix is looking good on the hold over this level. Notice the opening drive to the downside this morning, consolidation at the highs into the afternoon. Very clear setup, either continuation over today's high or continued consolidation, but maintaining a bullish edge. I would not be bearish on Netflix until we're back inside of the earnings range. So once again, where is that? It's down here. It's underneath and into this gap. It's looking for a move down towards this area at 569. Buyers totally have the upper hand. The structure here is bullish, holding on to the retest on the early morning session over 590.25. All right, two trade ideas. First one, Walmart. WMT is the ticker on that. And what you're looking for out of Walmart is a cup and handle on the hourly. One thing to make note of here is it recently split, 3-to-1 split. Used to be roughly, let's just use round numbers, 150 plus, right? So I have not traded it since the split. I am interested to hear your opinion if you have traded it post-split. How is the options chain? How's the liquidity? I'm sure it doesn't move like it used to move. Obviously, your deltas are much wider now. You're not going to get as much movement here. So it might not be attractive for that reason. But because of the setup, I'm at least putting it on a watch. And therefore, I'll learn something either way. If the setup works and the options do absolutely nothing, great. I'll know that we have to trade Walmart shares from here on out if the setup warrants it, or we just eliminate Walmart as a primary watch. We get rid of it, right? It's too cheap. The deltas don't move fast enough. The volatility is not there. It's a pretty slow mover in the first place. Anyways, that's Walmart, cup and handle up and over that 59.75, looking for a move in the upward direction. Let's go out to a daily chart just to make sure we don't really have an upward target. It's blue sky territories, all-time highs, I do believe. Let me make sure I'm not lying to you. Yes, the answer is correct. Blue sky territories. All right, next up, Coinbase, COIN. Everybody's talking about Bitcoin. Let's talk about Coinbase. Let's move it back on down to a daily chart here. Let's have ourselves a look. So obviously, large igniting bar after the weekend and Bitcoin breaking out. Coinbase plays catch up, and now we're getting 2 bars of consolidation above. If you extend this off to the left, it's also happening over this previous pivot high. So name of the game here is consolidation inside of this range, then looking for follow through in the upward direction. Here it is on the hourly time frame. It's kind of like it's just let it, what would you say? Let it marinate. Let this trade setup marinate. Let something come to you before you jump into this one. I would say we're watching the 2-day range. So far, the consolidation is bullish. Obviously, we know we have a catalyst. So if we're over 192.25, looking for potential hourly bull flags to maybe resolve over time to the upside, let's go back out to the daily chart and make sure we have a potential target here together. It's going to require the weekly, isn't it? Yes, it will. Weekly level overhead. So you're also dealing with a break of this weekly pivot, right? If I do something like this, you can see all the way back here as previous support, then acting as resistance. The next major level on the weekly, and again, I'm not forecasting this over the span of 1 week, 2 weeks, 3 weeks, even a month, but 273.85. You've got some room to run in the upward direction here based on the previous structure. So again, let this one marinate. I probably wouldn't jump into it immediately, but the structure does look promising for something to emerge as long as we're over that 192.25. We have thin structure underneath. So if you're like, nah, this whole Bitcoin thing, the whole crypto thing is a Ponzi scheme, it's a scam, it needs to go to hell in a handbasket, that's fine. Let it turn into a double top. Let it break down through the neckline. Lower highs below that level, 192.25. Thin structure retracement. First target would be here where the breakout originated from at 172. That's going to do it for today's episode of the Midweek Market Update. If you enjoyed the show or learned anything new, let me know down below in the comment section. Again, this is the road to 100K. We're going to start saying that more regularly around these parts. We will be live tomorrow morning for the PCE release. Coffee and donuts on me up in the penthouse suites. Come join us. Come hang out. It will be a good time. And with that said, I wish you a green trading week.